Good morning, everyone. This is Charalambos Pissouros, Senior Analyst at IronFX, bringing you the morning comment for the 3rd of February. Today, the US employment report for January will captivate market attention. The forecast is for non-farm payrolls to have risen by 175,000, a number consistent with further tightening in the labor market. We see upside risks to the NFP forecast, considering that the ADP report for the month crashed expectations and came in at 246,000, and that the employment sub-index of the ISM manufacturing PMI rose notably. The unemployment rate is expected to have held steady, while average hourly earnings are expected to have slowed on a monthly basis, albeit slightly. We don't think that a modest slowdown in earnings would be particularly worrisome given the strong acceleration in December. As such, we believe that this could be another month of solid employment gains in the US economy, something that could bring forth market expectations with regards to the timing of the next Fed rate increases and thus reverse some of the dollar's recent losses. Dollar yen traded lower yesterday, but hit once again support at the 112 barrier and rebounded back above the 112.60 line. The fact that the rate is back within the range between that support and the resistance of 115.50 makes us keep our flat stance with regards to the short-term path. Nevertheless, there is a possibility for the pair to trade higher within the range, especially if the NFP number surprises to the upside. Currently, the pair is testing the 113.25 level, where a break is possible to initially aim for our next resistance of 114. The pair also experienced some roller coaster trading overnight, primarily due to Bank of Japan's bond buying operations. As was reported, the Bank of Japan bought fewer bonds than market participants had anticipated, sending yields on Japanese government bonds higher and the pair lower. However, this reaction was short-lived, as the Bank of Japan announced in the following hours that it is willing to buy 5 to 10-year government bonds in unlimited amounts, though at fixed rates. These dovish comments caused dollar yen to rebound and trade even higher. In the UK, the Bank of England kept interest rates unchanged yesterday via unanimous vote, as was widely expected. We received a plethora of signals from policymakers, but none more important than the fact that they remain willing to look through above target inflation, suggesting that borrowing costs are unlikely to be raised anytime soon. However, some members of the committee have moved a little closer to their limits for tolerating such an overshoot. In our view, this suggests that there may be growing division among the members with regards to whether policy should be tightened in the future in order to curb inflation, which makes us believe we are likely to see some hawkish dissents in the upcoming policy meetings. With regards to the economic forecasts, the bank raised its GDP growth expectations for 2017 to 2% from 1.4% previously, though it kept its inflation forecasts for the next year more or less unchanged. GBP-USD spiked somewhat higher on the decision to hit resistance a few pips below the 127.20 barrier, perhaps as a result of the notable upgrade in the GDP forecasts. However, it quickly reversed its gains and tumbled even lower in the following minutes, as investors read through the meeting minutes and found very few hints regarding the possibility of a rate hike in the foreseeable future. This may have pushed back expectations for the next Bank of England rate hike, thereby triggering a fresh round of selling in the pound. The pair hit support near the 125.05 level, and if the bears manage to overcome it on a potentially strong US employment report, we could see the rate testing the 124.65 minor support or the 124.10 key obstacle. As for the rest of today's highlights, during the European day, we get the final services PMIs for January from several European countries and the Eurozone as a whole. In the UK, the services PMI for January is due out, and the forecast is for the index to tick down, but to remain elevated, notably above the key 50 barrier that separates expansion from contraction. A modest decline in the index may hurt sterling somewhat, but considering that the survey is expected to indicate that the economy's largest sector continues to perform at a robust pace, we do not expect this to influence the Bank of England's outlook. From the US, besides the jobs data, we also get the ISM non-manufacturing PMI for January, and expectations are for the index to decline slightly. We expect the indicator to pass unnoticed today, as dollar traders are very likely to have their gaze fixed on the employment data. We have only one speaker scheduled for today, Philadelphia Fed President Patrick Harker. For more information, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX, wishing you solid trading.